Banks don't ask for your income just to verify your information. They ask because your income quietly determines how profitable and how risky you are to them. And once you understand the real reason behind that simple question, a lot of the financial system starts to make more sense. Because whether you're applying for a credit card, a car loan, or a mortgage, that income box is doing far more work than most people realize. Today we're going to break down what banks are actually calculating, what they're really worried about, and how this affects the offers you receive, sometimes without you even noticing. Income is a risk filter, not just a number. At the most basic level, banks use your income to answer one core question. What is the probability this person pays us back? That's it. Every lending decision ultimately comes down to risk management. Banks are not primarily trying to be generous. They are trying to minimize default risk, maximize predictable repayments, and price loans according to statistical behavior. Your income is one of the strongest predictors of repayment capacity. But here's the important nuance. Banks are not just looking at how much you earn. They are evaluating income stability, income consistency, income relative to debt, and income relative to typical spending patterns. This is why two people earning the same salary can receive very different loan approvals. The debt-to-income calculation, DTI. One of the most important metrics banks calculate behind the scenes is your debt-to-income ratio, commonly called DTI. The formula is simple: monthly debt payments divided by gross monthly income. In the U.S., many lenders prefer to see DTI under 36% for comfortable approvals, DTI up to about 43% for mortgages in some cases. Above that, risk flags start appearing. But here's where most people misunderstand the system. Banks are not asking, can you technically make this payment? They are asking, how stressed will your cash flow become after we approve this? Because financially stressed borrowers behave very differently, and there's strong research behind that concern. Study reference number 1. Research from the Federal Reserve Bank of New York found that higher debt burdens significantly increase delinquency risk, especially when borrowers exceed sustainable payment thresholds. In some consumer segments, moving from moderate to high debt load increased serious delinquency rates by more than double. From the bank's perspective, your income is simply the denominator in that risk equation. Your income determines your profitability. Here's the part most people never think about. Banks are not only trying to avoid losses, they are trying to predict lifetime profitability per customer. Let's say you apply for a credit card. Two applicants. Person A earns $45,000. Person B earns $120,000. Even if both have similar credit scores, the higher income borrower often receives higher credit limits, better rewards, and more premium offers. Why? Because statistically, higher income customers tend to spend more, revolve balances more safely, hold more financial products, and generate more interchange revenue. In simple terms, income helps banks estimate how much money you might make them. This is why income questions appear even in applications where you might think credit score alone should be enough. Cash flow stress changes human behavior. This is where things get more psychological and more important. When your income is tight relative to your obligations, your financial behavior changes in predictable ways. You become more likely to miss payments, prioritize some bills over others, rely on short-term credit, or fall into revolving debt cycles. This isn't just theory. A well-known study by researchers at Princeton University and Harvard University found that financial strain and scarcity significantly impair decision-making bandwidth. In controlled experiments, financially stressed participants showed cognitive performance drops equivalent to losing 13 IQ points temporarily. Banks know this. They understand that when borrowers are financially stretched, the probability of mistakes rises, not because people are irresponsible, but because cognitive load increases. So when a bank asks for your income,
Part of what they're modeling is how close to the edge will this person be after we lend to them. Why income alone isn't enough. If income were the only factor, approvals would be simple. But banks layer income with several other filters: credit history, payment history, employment length, existing obligations, credit utilization, and sometimes industry risk. For example, you might earn a strong salary, but if your income fluctuates heavily month to month, lenders may view you as higher risk than someone earning slightly less but with stable W-2 income. Consistency often matters more than peak earnings. This is especially true in underwriting models for mortgages and auto loans.
Practical example: the car loan trap. Let's make this real. Imagine you're considering a car purchase. Your monthly gross income is $5,000. Current obligations: rent, $1,500, existing debts, $600, minimum credit card payments, $200, total fixed obligations, $2,300. Now you consider a new car payment of $750 a month. Technically, you might think, I can afford it. But from the bank's perspective, your DTI jumps significantly and your cash flow buffer shrinks. Here's what many borrowers don't see. When your margin gets thin, even small disruptions like a medical bill or job change dramatically increase default probability. Banks are not modeling your best month. They are modeling your worst reasonable scenario.
The hidden revenue side of the equation. There's another quiet reason income matters. It helps banks segment customers into profitability tiers. Higher income customers statistically tend to carry larger average balances, maintain more accounts, generate more interchange fees, qualify for premium products. According to data summarized by the Consumer Financial Protection Bureau, CBFP, credit card issuers earn substantial revenue not only from interest, but also from transaction fees, annual fees, and interchange. And higher spending households contribute disproportionately to that revenue stream. So when your income is evaluated, the bank is often thinking risk profile plus revenue potential equals approval strategy. It's not just about whether you qualify, it's about what type of customer you are likely to become. Why they sometimes ask again and again. You may have noticed something interesting. Banks don't just ask your income once. They often request updates when you request a credit limit increase, you apply for a new product, or periodically through account reviews. That's because your risk profile evolves over time. If your income rises meaningfully, you often see automatic credit limit increases, pre-approved offers, and targeted premium cards. But here's the warning most people miss. Higher limits are not purely a reward. They are also a calculated expansion of your potential borrowing capacity. And research backs the behavioral impact. A study published by the National Bureau of Economic Research, NBER, found that when credit limits increase, many consumers increase their borrowing. In some samples, roughly 10 to 14% of new credit line expansions translated into higher balances within the following year. Banks understand this elasticity very well, which means income updates are partly about recalibrating your risk and recalibrating how much you might borrow. What this means for you, practical takeaways. So how should you think about income questions going forward? There are a few grounded takeaways. First, your income shapes your financial leverage more than your credit score alone. Second, banks are always modeling your future behavior, not just your current numbers. Third, and this is important, just because you are approved does not mean the payment is comfortable long-term. Approval is a risk calculation. Affordability is a personal cash flow reality. Those two are related, but not identical. Final summary.
the calm truth. When a bank asks for your income, the question is doing multiple jobs at once. It helps them estimate your repayment capacity, your financial stress tolerance, your long-term profitability, and your future borrowing behavior. It is not just paperwork. It is one of the central inputs in the modern lending system. Understanding this gives you a quiet advantage, because once you see how lenders think, you start to evaluate financial decisions differently. You look beyond, "Can I get approved?" and you begin asking the more important question, "Will this keep my financial margin healthy over time?" That shift, small but powerful, is where many of the smartest long-term financial decisions begin. And if you keep that lens going forward, you'll navigate the credit system with far more clarity than most people ever do.
If this helped clarify things, subscribe for smarter financial insights. See you in the next one.